When your stock is down over 70% over the last year, and then you come out with a Q3 guidance number that comes $70 million underneath what the expectations were, well, yeah, your stock's probably going to get hammered. And we are seeing in the after hours Upstart holding down 9%, basically giving back the 9% gain it had during the regular session. With a lot of bad news clearly already priced into this stock, we'll go over the financials and we'll see if Upstart, if there's any value in this stock. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Upstart Holdings, ticker symbol UPST. As we said, over the last year, down 76% year to date, basically the same thing. Now you've got a minuscule $2.5 billion valuation on this one. This company is doing a buyback. We'll talk about that more here in a moment, but I want to jump into these Q2 numbers that came out after the bell today. We had revenues in the most recent quarter coming in at $228 million. That was 17% growth year over year, but it did miss expectations by about $7 million. Wall Street expecting a number closer to 235. We got 228. I don't think that's what's sending this stock down in the after hours, is the fact that they gave Q3 guidance over at Upstart of just $170 million. Wall Street was expecting a number far closer to $246 million. Even on the low end analyst estimates, they were right around $225 million worth of revenue. That $170 million worth of revenue is taking us back to a number we haven't seen over at Upstart in over a year. So tremendous headwinds for this company in the short term. Will they be able to wade through it? We'll certainly digest that as we move through these numbers. Now, the one thing that I do see when I look at the revenue estimates for the upcoming quarters for Upstart is the fact that analysts did have some consensus that revenue growth was going to slow considerably. In fact, even go negative in the fourth quarter, but somehow magically in the second quarter of next year, this is somehow going to reaccelerate back to a 40, 50, 60, 100% grower on that revenue side. And we're also going to do that profitably, at least from an EPS perspective. I don't know, looking at these numbers, if that is going to be possible, but maybe it is. Now, in terms of the most recent financial results, we had that revenue in the most recent quarter coming in at $228 million. That was 17% growth year over year. But what also grew over at Upstart was the fact that you had sales and marketing operating expenses go from $75 million up way more than your revenue growth to $105 million. Now, unfortunately, customer operations also more than doubled from $24 million up to $51 million. Your engineering and product development, you guessed it, almost doubled from 31 up to $57 million. And then finally, your G&A line went from 26 all the way up to $46 million. So a year ago, off of $193 million worth of revenue, this company had $157 million worth of costs and produced a solid income from operations of nearly $36 million. Definitely, absolutely, amazingly solid when you look at the total revenue being $193 million. That is why a year ago, this stock was 76% higher, because quite frankly, these are fantastic results. And Wall Street and investors clearly thought that was the future for Upstart. But look, we've just pumped the brakes over at this company, because off of $228 million worth of total revenue, our operating expenses came in at $260 million. So you take 228 and you minus off 260 and you just lost $32 million operating the business. Now, unfortunately, the upcoming quarter is clearly going to get even worse. So you have $170 million worth of revenue. Wall Street was expecting a number closer to 246. The company is projecting a negative net income just in that quarter at $42 million. In the most recent quarter, we had negative net income of 29, nearly $30 million. So this is going to get actually even worse in the upcoming quarter. Now, from a balance sheet perspective, we are seeing some cash exit the building. We'll show you what this company is actually using it for. And at the same time, borrowings ticks up from about $700 million up to about $856 million. This company has the ability to wade through some difficult times, but as I'll show you here when we move to cash flows, they are actually doing some fundraising while they're also buying back the stock at the same time. Now, the aforementioned cash flow statement over at Upstart, you pull down a 6 6-month number. And what's disastrous is last year we pulled down a net income for 6 months at $47 million. Now we pull down just $2.8 million. That's a complete disaster. Our stock-based compensation, thank goodness. I tell you what, the Rolex ADs and the Mercedes dealerships, wherever Upstart is based, is probably doing really well, because you notice last year on a 6-month basis where we actually generated positive net income of $47 million, we had $29 million worth of stock-based compensation. Flash forward a year, the stock is down over 70%. Our net income is absolutely shriveled up, but our stock-based compensation, thank goodness, almost doubled to $55 million, from $29 million up to $55 million, despite the absolutely dreadful performance that Upstart stock has had over the last year. I suppose there's some investors that could look past that, but if you bought this stock at a much higher price, this is what's driving you to likely have to take realized losses on an investment like this. Now, the net cash provided by the operating activities, a little misleading, because the fact that they have these purchase of loans held for sale, so they have about 1.1 billion of those. They sold in the most recent quarter, or the last 6 months, about 634 million of those. That certainly impacted cash flows, probably not as much as the fact that you pull down a positive net income of 47 million last year. Now you pull down just 2.8 million. That's the biggest decline, but you also have the fact that you originated far more loans than you did last year, and you only sold through a portion of those. Some of these have to do with accounting irregularities. Also factor in that Upstart could have originated loans towards the tail end of June, and by the time this quarter is cut off, some of these loans held for sale, maybe they close August 1st, August 2nd, or into the August timeframe where it follows through in another quarter. So wouldn't necessarily get wrapped up on these net cash provided by operating activities. It can get skewed one way or another, depending on how this company wants to make this look. They could sell through a ton of loans in a quarter, not originate that many of them, and it'll make their cash flow look really good. So I wouldn't really judge them on that. I'd really judge them on the fact that they have this net income number shrivel up year over year, and now you're having your revenues absolutely shrivel up as well underneath the guidance, well underneath expectations, and really starts having investors and certainly analysts as well start projecting, like, are we really going to reaccelerate to 261? Is this company really going to go from 170 million and then all of a sudden snap back and do 260 in revenue in Q4? Are they really going to do 314 in Q1? Certainly great questions to ask, and I don't think this company is going to be able to do that. Company's basically a break even on that investing cash flows. We do see, oddly enough, interesting, and it's not really odd, it's more interesting enough, this company is rebuying the shares. They to the tune of 125 million over the last 6 months. They also borrowed money during this time as well. Proceeds from borrowing coming in at 261. They repaid about 100 million of that. Obviously, when we look at Apple and Facebook and Google and all these companies, they're taking on debt or bonds and then buying back the stock. But the difference is those companies are wildly profitable and not slashing their Q3 guidance by almost basically 50% year over year. So while I appreciate this company doing financially healthy things, if it puts up several quarters that are as bad as this quarter and the upcoming quarter, they sure as heck are going to want that $125 million back. But right now it is gone. From a fundamental perspective, in the shorter term, this is actually going to get worse before it gets better. So you have to have faith that somehow this company's technology is going to be integrated into far more loan originations into the future. And on top of that, despite the higher interest rates, you're somehow going to see a reacceleration of loan demand, which I'm sure will happen at some point. Will it happen in Q1 of next year, or will be all the way back in 2024? Or if this is a prolonged recession, maybe we don't see loan demand really coming back in force until 2025. That certainly would be bearish for a stock like that. Now, speaking of bearish, look, in the longer term trend, this stock is basically just headed straight down. Now, the downtrend is starting to shallow out a little bit, but not a whole lot, to be honest with you. Now, we are seeing this with a lot of stocks that we are looking at. The fact that in the more intermediate, very, very shorter terms, probably a better way to say it, we're starting to see a flattening out of the downtrend. Now, you still are making lower lows here, and lower highs on this stock as well. That's a deviation from some of the other more speculative stocks that we're looking at, like a Palantir, certainly like a SoFi, which is in the same category as this stock. Those stocks are actually in very shorter term uptrends, making higher lows and higher highs. This one's actually making lower highs and lower lows. I think also from a technical perspective, that's also sending this stock lower in the after hours. Now, complicating the situation a little bit is we are basically on the 52-week lows on this stock. Now, the 52-week low I see here is $22.42. We're basically $7 higher at $29.42 on this stock right now. But all intents and purposes, you're basically on 52-week lows. So there should be someone defending this stock at this area since they have stepped in the past. Your danger, though, is you drop out the bottom of this demand. And if buyers dry up at this key level of support, and considering in the shorter term, the stock is still locked in a downtrend, both a steep longer term downtrend, but also a downtrend in the shorter term, I would say the odds are this one continues to actually head lower. I would not want to get in front of this train despite the buyback, despite some of the healthy trends that we're seeing with this company. It has been reversed. I would want far more clarity on what not only this company thinks, but analysts that are expert in this type of field, what they feel about loan demand and this company's prospects heading into Q4 and then Q1 into next year. Are we really going to reaccelerate our revenues back to a more normalized level, or all these estimates going to have to get taken down, which would likely create a cascading effect, sending this stock lower? I know we have just a $2.5 billion valuation, but when your revenue was expected to be 246 and now it's 170, and there's great questions on can we even reaccelerate back into the $300 million range, that $2.5 billion valuation can actually seem incredibly rich depending on how long the headwinds remain in the lending space. I personally would rather hide out in far more other stocks in the financial sectors, even more speculative ones, rather than Upstart at the current time. Hopefully you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.